Welcome to Kaplan Professional Education's monthly economic update. I'm Michael Pollock, and this month we're speaking to AMP Chief Economist Shane Oliver. Thanks for joining us today, Shane.
Pleasure. Great to be here.
Shane, what's your view on growth for the Australian economy going into 2016 within the context of inflation and unemployment?
Well, I guess for the last little while we've been stuck in a zone of growth around 2 to 2.5%, and obviously you've got the huge drain from the end of the first phases of the mining boom, particularly the slump in mining investment. Against that, though, you've had other sectors of the economy look a bit healthier, like housing, like consumer spending, services exports, and of course the final phase of the mining boom, which of course was the resource exports that flow from all the mines. All those things are sort of keeping the Australian economy afloat. Going into next year, I think for much of the year it's going to be more of the same. We just had a pretty strong September quarter. Might be a little bit slower going forward because there were some one-offs in there that won't be repeated, including a recovery from disruptions in ports in the June quarter, which suppressed exports, and they bounced back in the September quarter. But notwithstanding all of that, I think we're sort of going through this ongoing phase. Still got the downswing coming through from mining investment. Commodity prices are low. Those things are drags. But you've got other parts of the economy which are providing an offset. So I think for much of 2016, we're going to be stuck in that 2-2.5% range. Maybe later in the year, particularly if the Aussie dollar falls further and maybe the Reserve Bank cuts interest rates, then we might perk up to around 3%. So I certainly don't see a slump in the economy, but it's hard to see a boom either.
Where do you stand on the idea that the current softness in commodities prices is the downward phase of a commodities supercycle?
Well, I tend to agree with that. If you look back through the history of commodity prices over a long run, you find that you have these super cycles. Now, the term super cycle was most commonly referred to the last big upswing, which went from around the year 2000 up until about 2011, give or take, depending on which commodity you're looking at. Now I think that phase has turned into a downswing. And if you go back prior to that, the previous downswing ran from around 1980 up until the year 2000, and prior to that was about a 10-20 year upswing. So you have these secular or super cycles in commodities, and it reflects the interaction of demand with the lagged response of supply. So what happened a decade or so ago was that demand coming out of China in particular picked up. Mining companies initially didn't believe it, then they did, and of course then they respond with a huge increase in supply, which is now hitting the market. And of course China in the meantime has slowed down at a time when all this supply is hitting, so surprise, surprise, we're now in this downswing phase in commodity prices. And I think that's probably got maybe another 5 to 10 years to go.
How much of an impact has a lower exchange rate across 2015 actually had on the productive capacity of the Australian economy?
It's always hard to measure these things precisely because it's hard to disentangle the effect of the exchange rate from other things going in the economy, but I think it's been a huge help. The Aussie dollar's fallen from a high of $1.10 back in the year 2011, so 4 years ago, and lately we've been down closer to 70 cents, give or take a bit. And that's a huge decline, a huge boost in competitiveness for Australia. So we're starting to see record numbers of tourists come to Australia. Australians, when they think about their holidays, they're now sort of thinking, well, maybe we'll just stay in Australia, go to Port Douglas or Tasmania or somewhere rather than go to America, because it's now relatively cheaper to stay here than go over there. And likewise, manufacturers that have managed to hang in there through the high Aussie dollar years are now still hanging in there. And some of them, I hear, are operating at closer to full capacity again, depending on what industry you're in. So I think there has been a big help to the Australian economy from the fall in the Aussie dollar.
Former Greek Finance Minister Yanis Varoufakis was in Australia last month, and while he was here he gave a warning that Australia is headed for recession. Where do you stand on that?
Well, I respect Yanis Varoufakis and his comments, but I've got to point out that those sorts of comments have been made by foreign commentators, people who live overseas, several times over the last 3-4 years. There's a general perception that Australia is a one-trick pony, i.e. it's just a resources country, and whenever resources go bust, then Australia will have a recession, and that seems to be the logic. The trouble is that I think Australia is a lot more complicated than that, and it also misses the nature of the last cycle. So when we had in the old days, when you had a boom in one sector, mining or whatever, then all parts of the economy seemed to be booming at the same time. So when the key sector turned down, everything else turned down at the same time. We had a serious and deep recession. This time around, we had a massive mining boom, biggest in our history, but much of the rest of the economy was knocked into a hole. The old saying was the people of the western suburbs of Sydney were paying the price for the boom in northwestern Australia. And I think there's an element of truth in that, because they did. They got higher interest rates than otherwise would have been the case. The high Aussie dollar might have seemed nice if you want to go on an overseas holiday or import something on Amazon, but not so good if you want to keep your job, if you're competing internationally. So I think what's happened now is that the mining sector's gone bust, and those sectors that were repressed, they're now recovering again. And I think a lot of this sort of foreign-based commentary, including from Yanis Varoufakis, misses that point. Misses the point that New South Wales and Victoria, that were struggling through the so-called two-speed economy era, have now bounced back, and we've got the two-speed economy in reverse. So I think it's very unlikely that Australia is going to have a recession. Yeah, there's some risk there. If the world falls over, yeah, we're vulnerable. But providing the global economy holds up, and I think we'll continue to rebalance our economy, and therefore we're not going to see the recession.
Turning to China, what do you expect to be the biggest changes for the Chinese authorities as they negotiate the so-called middle income trap?
Well, the middle income trap is that period where you go from being very poor, give some people some machines and what have you, and a lot of people move to the cities from the rural areas, so that gives you a boost to growth. And then you get to a point which is sometimes called middle income on a global scale. You become a middle income country and your growth rate slows down. And you have to change your growth model. You can't just rely on moving some people from rural areas to cities and giving them machines. It has to be a lot more innovative than that. And China, I guess, increasingly finds itself in that position, particularly for the provinces that are down the east coast seaboard in China. Will it make the transition? I suspect it will. It seems the Chinese leadership is quite sensible in this regard. They understand the need for economic reform. But by the same token, they also understand the need to keep growth going if they want to remain in government, so without mass protests. So I think we are seeing in China a sensitivity, awareness of the more difficult phase the economy is in, but by the same token, not wanting to push reform so hard that it ends up destroying short-term growth and then create social disruption. So I'm reasonably confident on China, and I think a lot of the fears over the last few years, the so-called ghost cities, the talk that there'd be a property crash, the shadow banking system worries, the share market turmoil we've seen this year. Through it all, the Chinese economy just seems to keep motoring along, albeit not at 10% anymore, more like 6.5%, 7%.
And what's your outlook for China overall this year?
We're looking for growth around 6.5%, so edging down a little bit from where we are at the moment, but that's, I think, more a longer-term structural edging down. Population growth is slowing, and I think it's just an adjustment in the economy to a more sustainable rate. So I'm certainly not in the camp that says there's going to be a hard landing in China, and I'm also heartened by the fact that the Chinese authorities realised that maybe they were a bit too tough in terms of the monetary policy they were running. They've been cutting interest rates steadily over the course of the last 12 months, and I think that process will probably continue. So China's growth around 6.5%.
Looking at the US, to what extent do you expect exports to be weighed down by a further appreciation of the currency and a weaker Chinese economy?
I think for the US manufacturers, it's already been a difficult year through 2015. The rise in the US dollar that had occurred through much of 2014 and continued into 2015 really weighed on manufacturers, and they obviously impacted their competitiveness. My feeling, though, is that the bulk of the strength in the US dollar is probably behind us. I still see downside in the Aussie dollar, but I don't see a lot of upside in the US dollar on a generalised basis. May drift a little bit higher, but not dramatically so. And the reasons I say that is that the Fed will probably raise interest rates as we go through the course of 2016, but it's going to be a very gradual process. And I think that gradual process will limit the upside pressure on the US dollar, and therefore manufacturers probably still struggling in a relative sense, but I don't see major problems for them. And against China, I mean, the main issue for US manufacturers competing with China, or hoping to export to China, is is whether the renminbi stays around the current levels versus the US dollar. And I think that's probably going to be the case. I don't see a huge devaluation by the Chinese authorities of the Chinese currency. And in fact, they've told us if you're looking for that, then you're not going to get it. So I think the real issue for China and therefore the flow on to US manufacturers is the extent to which the Chinese economy continues to slow. And if I'm right that Chinese growth sort of stabilises around the 6.5% level, then demand for US manufactured goods probably won't fall that much from here. So overall, I'm reasonably sanguine on the outlook for US manufacturers, but yeah, it's not as good as it was a few years ago.
What will be the major outcomes for the economy this year of the Fed's increase in rates?
I think what we saw happen through 2014, which saw the US share market largely sidelined, and then it had a correction in the September quarter. I think a lot of that factored in US interest rate hikes. And likewise, the earlier rise in the value of the US dollar largely factored in the prospect of interest rate hikes in the US. And I think one of the key things coming out of the Fed is that interest rate hikes going forward are conditional on the economy continuing to improve and getting more confidence that inflation will pick up. In fact, you can argue that Janet Yellen has in fact tied interest rate hikes through 2016 to seeing more confidence that inflation in the US will rise. So I think it's going to be a very gradual process. I think the world is still very deflationary. Commodity prices are very low. A lot of spare capacity around, people saving more than they used to. That's all going to keep a lid on inflation and also keep a lid on inflation in the US. So against that backdrop, I think the moves by the Fed will be very, very gradual. The last thing the Fed wants to do is sort of hike rates aggressively, cause a huge surge in the value of the US dollar, cause problems globally, because they know all of that will blow back and hit the US economy and make it harder for them to keep progress towards getting their inflation target.
So finally to Europe, Shane, what's the outcome of the ECB further easing monetary policy as the US conversely moves to tighten?
Well, I guess in some ways we have seen elements of this in the past. You know, where one of the major blocks goes in a different direction to the other ones. A few years back, America wasn't tightening. They were still easing, and the ECB was actually tightening. Go back to the early stage of the Eurozone crisis, the European Central Bank was actually tightening. So we have seen these divergences in the past. I think at the moment the main implication is what it means for the US dollar, that a easing European Central Bank and a tightening Federal Reserve, all things being equal, means a bit of upwards pressure on the US dollar. Flip side though, I really don't see it having a long way to go, because US dollar's already risen 20-odd% from where it was, say, 2 years ago. And so therefore, at the end of the day, I tend to look at it more, not so much in a relative sense, but I look at the global economy and sort of think, well, you've got a bit of monetary tightening going on in the US, but it's not much. And then you look at Europe, and they're still easing and pumping cash in, at 2017 on current guidance. Japan's still pumping cash in, China's still easing. So overall, you've still got this global economy, which on balance is still easing, notwithstanding one of them gradually tightening. But it's still a relatively friendly environment for growth-related assets for equity markets, given you've got that monetary easing coming through.
And what are the core reasons for the persistently low inflation in Europe?
Well, Europe does have a problem with low inflation. You could argue Japan has as well over the last 20 years, and I suppose the Europeans sort of think, well, maybe there's some risk that we'll go down the Japan path, with rolling bouts of deflation. Obviously, all countries around the world have seen the fall in the oil price push down headline inflation rates, so that's one factor. But the core rate is the one you need to focus on, and in Europe that's just around 1% or just below, and that's a lot lower than the ECB would like to see. Their target is around 2%. But it's the picture. It's a similar story globally, perhaps a bit more in Europe. But I think the reality is we've got a lot of spare capacity here. If you take the Eurozone jobs market, the unemployment rate is 10.7%. In the US, it's 5%. So you've got a lot of underutilised people out there. Likewise, in factories across Europe, still got a lot of spare capacity. So I think this spare capacity issue, the failure of growth to pick up faster, That's largely what's explaining the low inflation, and on top of that you've got these very low commodity prices feeding through.
Within that low inflation climate, what do you expect to be the main drivers of growth in Europe this year?
Well, there's always a bit of natural growth come through anyway. Not every year, but most of the time you get a bit of natural growth reflecting innovation, population growth and so on. And I expect that continues. We're looking at a world of relatively constrained growth. Every year for the last 4 or 5 now, we start the year off and the IMF's talking about 4% growth for the year ahead, and then as the year proceeds they have to revise it down to around 3%. This is for the global economy. Similar story, in fact, for Australia, that government, RBA, economists have been thinking, well, sooner or later out there's got to be a pickup in growth. Then we get there, it never happens. I think we just have to resign ourselves that it's a more constrained environment. So yes, you do have population growth, but it's not as strong as it used to. It's been slowing down. Productivity growth is occurring. There's innovation going on. We're getting new gadgets every couple of weeks, some new invention somewhere. So all of those things help growth continue. It's just that it's not quite as strong as it was, say, prior to the GFC.
Thanks very much for your time today, Shane.
My pleasure, thank you.